Welcome back to the Australian Fund Monitors Meet the Manager series. The AIM Global High Conviction Fund was started in 2015, although in 2019 the fund was restructured from a currency hedged global long short fund to an unhedged global long equity fund. Since the change of mandate, the fund has returned 11.25% per annum, outperforming the global equity index by over 5.5% per annum. Importantly, the fund has fared very well against the index in a range of risk measures, including significantly lower maximum drawdown and a down market capture of 70%. I'm joined today by Charlie Aiken, CEO and Portfolio Manager for AIM. Charlie, thanks for joining me.
Thanks, Damon. Thanks for your time.
Charlie, as I mentioned in my introduction, the fund's had strong performance over the last 12 months and especially through 2020. What's generated the fund's performance through 2020?
Yeah, it's been an amazing year, Damon. I suppose when you started the year, you never predicted that you'd be interrupted by a global pandemic. That's not something that you generally have on your list of risks. So it's been an extraordinary year. The fund focuses on super high quality investments around the world. So our investment process has driven a lot of the return, but also many of the decisions we made earlier in the year in the peak of the pandemic-related market meltdown, if you want to call it, have proved to be good decisions. We simply stuck to the process. We tried to control what we could control, not be experts on viruses or vaccines, etc., and control the controllables, which means the stocks that we own. So the process has worked really well. We've tried to keep it very simple. We've tried to focus on the future, and we've also tried to rule out any permanent loss of capital. The worst of the virus-related market meltdown in March, it really was about owning companies that you knew would be around. Our process leads us to very strong balance sheets, so survivability was one thing that's driven our outperformance, and we're also not nicely diversified. The other decision I think we made that was right in hindsight was not to raise high amounts of cash at the bottom of the market, to stay invested, to be diversified, and to see it through. So I'm not saying that we did anything dramatically different to many people, but we stuck to the process, stayed invested, and stayed really heavily involved in high-quality businesses, and that's how we've got here.
That said, though, there's been a pretty large variance in the return for global long-only managers over the last 12 months, with many managers failing to produce a positive return. So clearly this is not just a value versus growth argument anymore. Where does your fund's investment philosophy fit in?
Yeah, we call ourselves quality, which means you can invest in growth stocks, you can invest in value stocks, but the one overarching requirement is they are super high quality. By high quality, we mean high sustainable return on invested capital, fortress balance sheet, as I mentioned, high free cash flow, or they deliver cash flow that we can identify, and a resilient and experienced management team. So those four factors drive our investment process and whether we'll select a stock. We also run a concentrated portfolio. We only own 21 stocks. We think that's enough diversification to deliver us alpha as well. But really, we don't really buy into the value versus growth argument. We think there's certain times when certain attributes will outperform in the short term. But in the long term, we believe superior businesses outperform. So we own what we consider superior businesses. And we think that we have a different product than most in the market. I'm not here to make comments on how other people run money. That's how they do it. We really focus on ourselves, and we focus on our process and focus on delivering for our clients. So with quality, you can have an overarching quality factor that allows us to have a portfolio that owns Berkshire Hathaway and Amazon in the same portfolio, which is somewhat different. Why? Yes, you could argue that Berkshire's more value and Amazon's more growth, but they're both superior quality on all the attributes we look for. So we don't think that it's about being in one way or the other. But if you have a diversified portfolio that has the attributes of quality, you can own quite a variety of different stocks and sectors. It doesn't mean you're all tech or all industrial cyclical. So we're probably a bit of a crossover fund, but the overarching variable is super high quality.
How are you positioning the portfolio for 2021? Are you looking to make changes, or are you just sticking to your knitting?
Yeah, interestingly, as the calendar flicks over to a new year, you don't really change anything. It's interesting. It's a new performance period. It's a new measure period. But do you change anything in what we're doing? No, I think the only difference in the year ahead is there's probably a pathway to a vaccine and a slightly more normalised world. Thankfully, we've got a portfolio that's well diversified. And in a very strange outcome this year, some of our worst performing stocks are actually defensive stocks, things that you would usually hold up in a in a recession. But due to the nature of the recession, a lockdown driven by a virus, stocks like Coca-Cola and Heineken have been big laggards for us. So some of the things that would have traditionally done well in a recession have done quite badly. And I think we're probably looking for a little bit of leadership change in our portfolio. Without changing our portfolio, we expect some of those laggards to do a bit better, as they have in recent weeks on news of a pathway to a vaccine. But really, Damon, I think it's about being fully invested. We will remain fully invested and unhedged to the currency. I personally believe the outlook for next year is positive. I think equities broadly will do quite well. We've got super low interest rates. We've got fiscal stimulus. We've got probably a more benign political environment out there after the change of government in the United States. And I think the pathway ahead for equities is it looks quite okay for the year ahead. So I think the key for us is to stay fully invested, to know our companies as well as we can, to be diversified in the portfolio, but not change much. One of the keys to any success we've had this year is not trading the portfolio much at all. Sticking to your knitting, as you say, sticking to your conviction, doing the work, and then letting the portfolio perform without transacting too much or trying to chase every short-term headline that comes up. So for us, the key thing is really sticking to the process. Just do what we do. It's worked reasonably well this year and continue to hopefully work well next year. But you must stick to the process and not get distracted by every short-term headline.
Sage advice, Charlie. Thanks for joining me and good luck.
Thanks, Simon.